Hello and a very warm welcome to everyone who's downloaded this webinar. Today, as part of London Business School's 50th anniversary webinar series, Professor Chris Higson will be speaking about balance sheet innovation. My name is David Ratcliffe. I am the Programme Associate for our Executive Education Finance Programmes. And I'm also joined today by Anne White, who is a Programme Director.
Hello.
We will be putting some of your comments and questions that you've already submitted to Chris as we go along, so thank you for your input. Professor Higson will be talking for roughly 40 minutes on how balance sheets are evolving as companies increasingly use asset-light strategies to gain a competitive advantage. For anyone unfamiliar with Chris Higson's work, Chris is Professor of Accounting here at London Business School, where he has worked since 1986. His areas of expertise are in financial statement analysis, financial performance and valuation, taxation, governance and regulation. He serves as an expert witness in the areas of accounting practice, corporate finance and taxation. During his career, he has advised or coached senior management in many of the world's leading industrial, financial and investment companies. Chris has authored well over 100 academic books and cases. His most recent book is Financial Statements, published by Rivington. You can avail yourself of Chris's expertise and insight if you attend his corporate finance, accounting and financial analysis programme, which we hold here twice a year in a 5-day block week format and also in a 10-week part-time evening format for those of you based in London. I will post further details for the programme dates for 2015 later on, so do feel free to email me if you'd like any further details. So for now, without further ado, I will hand you over to Professor Chris Higson.
Thank you very much, David. Let me explain what I'm going to do in this webinar. In the corporate finance program, we talk deeply and intensely around the issue of financial statements and how they enable us to explain and analyze the economic performance of companies. And there are a number of themes that recur there. And in the webinar today, I'm going to pick up one of those themes. It's a central theme, actually, in the analysis of financial performance these days. And to explain it, let me step back and paint the big picture. And the big picture in corporate finance, and certainly the big picture when we're reading the financial statements of companies, centers on the idea of value creation. We understand that a company creates value for its investors when it does two things. It takes money from its investors to buy the assets he needs, and investors have a rate of return they want the company to earn on their money. So the first thing the company needs to do is to earn an adequate return on the capital that it's employing. The second thing it must do is grow, because if investors find a company that can create and sustain competitive advantage, which is the necessary underpinning for earning a superior return on capital, they want that company to grow, because the more it grows, the more wealth it generates for its investors. So let's think more about this idea of return on capital. The profitability of a company, its return on capital, is measured in terms of the profit it earns in a year and the assets it's using to earn that profit. Now that measure, that rate of return on capital, the ratio of assets, the ratio of profit to assets, it can be usefully decomposed into two parts. Step one, how much profit does the company earn from each dollar of sales? We usually call that the profit margin of the company. Step two, how much sales does the company generate from its balance sheet, from its assets? Or more usefully, thinking about that the other way up, how little asset can it use, can it manage with to deliver its sales? We call that a relationship between the sales of the company and its balance sheet, the asset turnover. So the return on capital a business earns for its investors, which is this core measure, is simply the product of two other numbers: the profit margin on sales, and the asset turnover. Now we know that the modern world is getting more and more competitive, And that means that it's harder and harder to outpace your competitors in terms of profit margin. Margins are under extreme pressure. We do a lot of research on this at London Business School, and in all the industries we look at, we find that globalization, the IT revolution, and deregulation, these factors which have characterized the competitive landscape over the last 10 or 20 years, exert continuous pressure, downwards pressure on margins. So what do we do in that case? Well, attention shifts to the other side of the equation, to the asset turnover. And what I'm going to talk about in the webinar is the patterns and behaviors I observe around asset turnover, and the way that companies, successful companies, are looking for and finding disruptive innovation in balance sheet structure that enables them to deliver a margin, to deliver sales with much lower assets than before. This is all about the balance sheet. So for those of you who aren't familiar with balance sheets, let me explain the logic of the balance sheet a little, using some examples. A balance sheet is simply a list of the assets the company is using and a list of where the money came from to buy those assets. And the balance sheet is the core document in finance. I've taken 4 companies here to demonstrate this. 4 familiar companies, well, most of them I think will be familiar. Let's start with Tiffany. Tiffany, a US 100-year-old legendary US high-end jewelry business. Think of Audrey Hepburn, Breakfast at Tiffany. Reports under US accounting rules. This is Tiffany's balance sheet in January 2013. And what we're going to do is simply read across these balance sheets and see how successful the balance sheet structure is in revealing the assets that a company uses. What assets does Tiffany use? Well, the eye catcher in Tiffany's case is the inventory that it holds. Tiffany has just over 4 billion of assets at this date. You can see that. That's the total assets of the business, 4159. Around half of that, we see higher up the page, is simply sitting as inventory, roughly 2 billion. And in many years, that accounts for a year's worth of sales for Tiffany. So Tiffany sits on an extraordinarily high level of inventory, it would appear. And that's the most striking asset characteristic of Tiffany's balance sheet. Let's move across. Who are Odgefell? Well, perhaps less well known, a Norwegian logistics shipping tankerage company. What does this company have in its balance sheet? Well, overwhelmingly, what we call property, plant and equipment. These will be the ships, the ground facilities, the buildings that it needs. This is a classic capital-intensive business. Asahi, who are they? Well, again, very familiar Japanese brewing company. And of all the 4 companies I've chosen here, this is probably the one which has the most conventional manufacturer's balance sheet. It's got a balanced portfolio of assets. It has some inventory, has quite a bit of property, plant and equipment, presumably the brewing facilities, the distribution, the offices, because essentially it's a business with a global footprint. Quite a lot of receivables, the money its customers owe at this point, and investments in intangibles. And I'm going to say a little bit more about those by reading across to the final company, which is Publicis. Now, Publicis is quite different to the other 3. Publicis is a pure service company. It's an advertising agency, or to be more exact, it's one of the world's 3 dominant portfolio advertising agencies. It's a company built, it's a conglomerate built by acquisition over a number of years. So it holds a portfolio of ad agencies, PR companies, media businesses, and so forth. If I was to say, what sort of assets would you expect to see in the balance sheet of an advertising agency, you'd probably scratch your head, because these businesses at first glance are all about human capital. They're all about intangible assets, reputation, relationships, creativity, all the things that we know famously don't get into balance sheets. And indeed, there's little or no inventory. There's little or no property, plant and equipment. But what there's a lot of here is receivables, because this business is, as its name suggests, an advertising agent is at the end of the day an agent. It stands between the client and the media outlet to whom the advertising campaign is being sold. So at any point there's a large balance of money owed by the client to publicists. But the one point I really want to draw attention to here is the role of intangibles and investments, because publicists like WPP and Omnicom, who are its two main rivals, has grown very energetically by acquisition. And when you acquire other companies, especially if there are other companies that have a lot of intangible assets, then you have to account for that on your balance sheet. And so a large number in Publicis' balance sheet is the balance of acquired intangible assets, and if we can't put any other name on it, we call that goodwill. So just to summarize what we saw there, whatever four companies I would have lined up in that comparison, I tried to choose some companies that span the world and span the globe, but also span the industrial types that we meet. We'd have seen that the assets they use, and therefore the shape of their balance sheet, is to some large extent destiny, but it depends what business they're in, and that was very clear. The very different businesses those companies were in showed up in very different asset requirements. It's going to be affected by the efficiency of management, because particularly given the discussion early on, where we know that margins are under pressure, so to deliver a decent return on capital to investors, companies are having to focus on running their balance sheets tightly. So efficiency in balance sheet management, tight working capital management, keeping inventory down, making your customers pay promptly, and so on and so forth. Efficient use of tangible assets, only using the buildings, only using the machines that you actually need. They're going to be part of the story, and that's going to differentiate the balance sheets we see. It's going to depend on the accounting rules, and that's not something I'm going to talk about today. GAAP, GAAP, generally accepted accounting principles, govern how companies measure their assets, what values they put on them, but also, of course, what gets into the balance sheet. But finally, and this is going to be my focus, it's determined by the balance sheet model the company chooses, because in this very competitive world with margins under pressure, there would be an enormous reward to finding a balance sheet model that needed radically less assets than hitherto. And we can do that in several ways. So companies make hard decisions about whether to own the non-strategic assets they have, whether they should simply exit some activities altogether in the value chain. If some activity is simply not creating value, is not profitable, let's exit, so we won't need the balance sheet that goes with it. There are accounting games using tricks such as operating leasing. Those are outsourcing. Let me give you some examples. And the example I'm going to start with, and I think it's one of the most striking examples we have, and it was an innovation that was copied to greater or lesser extent, with more or less success by many, many companies, is Michael Dell's disruptive innovation. Michael Dell, Dell Computer, was one of the pioneers in the personal computer world. And he found a world. He'd started his business very young, famously, as a young college student. He arrived in the 1990s to a world where the PC industry was intensely competitive. It was a competitive wasteland. In the first 5 years of the 1990s, unit prices in the computer industry, the personal computer industry, were falling by something like 15% a year. So just to survive in that sort of a world meant intense cost cutting, and many companies didn't survive. Michael Dell said, well, I want to do better than survive in this business. I want to earn stellar returns for my investors. How can I do it? Well, it's not going to be margin, because margins in a world of falling unit prices and intense cost cutting are under pressure, extreme pressure. We'll do what we can with margin, but he turned his attention to the balance sheet. And let me show you what he did. Here I'm comparing Michael Dell's balance sheet in 89 and 90, which is in the early days of his business, before the torrid first 5 years of the 1990s, and then a decade later. Let's look at the first 2 years. In those years, he was earning a return on capital which was respectable, of 34% and, well, not so good, 13% in 1990. After tax, 23% and 8%. So a return that was perhaps at or above the investor's required return, the cost of capital. And how was he doing it? Well, in terms of that profitability equation, margin and asset turn, the 34% in 1989 came from an 8 or 9% margin associated with an asset turn of 3.9. Now this idea of asset turn is the one you might be less familiar with, and I need to spell this out rather. The asset turn relates the balance sheet to the sales of the company. And if you have an asset turn of 3.9 times, it means that about $1 of asset in your balance sheet is supporting 3.9, almost $4 of sales per annum. So what lay behind that? If we dig into his balance sheet, we'd have seen that he actually had very small, in terms of on the balance sheet, assets, very small balance of fixed assets. I suspect he was operating leasing, quite a lot of his factory space, warehousing and so forth. But the number that was very large, by contrast, strangely large you would think, in a fast-moving consumer product business like this, was inventory. His inventories were 25% of sales, which, related to cost, would probably represented something like 4 or 5 months worth of production. By modern standards, that's an extraordinarily high level of inventory. And receivables and payables are pretty much the remaining key items here, and those were fairly well in balance. Yeah, each dollar of sales, he found he had to invest 10 cents in customer balances, the amounts owing by customers, but equally each dollar of sales was generating around 9 cents worth of credit from his suppliers. So those two factors were offsetting each other. Roll forward by 10 years. How does he look now? Well, completely transformed. The EBIT margin, not much different. 1998, 1999 turned out to be two of his best years for margin. So a little change there, but what changed beyond recognition was his balance sheet. And this was the key to Michael Dell's innovation. He found a completely different balance sheet model. Not much different in terms of fixed asset. There were hardly any of those to start with, but of course the key is the disappearance of inventory. Now he can run this business with hardly any inventory at all. Only 2 cents on the dollar of sales needed to be held as inventory compared to the 25 cents a decade earlier. And there's been a slight improvement in receivables and payables, but it's basically all about inventory. How did he do that? Well, famously, much described and much copied, the intensive use of IT. He was selling over the internet to a very large extent. He built, through a very sophisticated IT modeling, an integrated logistics system so that his suppliers delivered the components, often semi-complete final products, to the factory door just a few minutes before he was going to need them to assemble the product. His customers would pay in advance and he would ship the product as soon as it was assembled, so hardly any inventory, just-in-time manufacture, and a very favourable relationship with customers in terms of their willingness to pay ahead of time. Add all these factors together, he now has an asset turn which is infinite. What does that mean? It means that he didn't actually need capital from outside investors because the assets the business used were so few, and the transforming factor was the inventory balance, that the credit he was getting, the liabilities that the business generated, the money owed to him the money he owed, to his suppliers, the money he owed to the tax authorities, the other liabilities of the business, were just about enough to fund the assets. So the balance sheet looked after itself. No capital was required. The net assets of the business was zero or negative. And therefore, the asset turn, the relationship between sales and net assets, infinite. And whatever your margin, and in those 2 years was respectable, Dell's margins that started to fall after this, but in those years, pretty good margins. Whatever your margin, if your asset turn is infinite, if you don't need a balance sheet, if you've re-engineered your business model so that you don't need a balance sheet, then your return on capital is infinite. And that's a very neat balance sheet model, if you can achieve it. Oddly, and since it's quite easy to describe, it's clearly quite hard to do because many of his rivals struggled and failed to do what he'd done. IBM, Compaq in those days, later acquired by Hewlett-Packard, the big incumbent players, perhaps because they had a legacy of assets. They were not the new kid on the block, as Dell was to some extent, found that they couldn't shrink their balance sheets to that extent. One company that succeeded in doing it, and I think we must attribute quite a bit of Apple's current success to this balance sheet innovation, was Apple. These are Apple's numbers for the last 5 years, up to 2014. And slightly more numbers on the page, but just let me point you to the key numbers, the key data which are down at the bottom. What is Apple's profitability equation, measured in the same way as we did for Dell? Well, its margin is much fatter. I mean, Apple's extraordinary success in both growing at a very high rate, you can see that at the top of the page, its sales growth. In the years 2010, 11, 12 in particular, it's rather slowed in the last 2 years. It's stellar, but equally, it's earning the highest profit margin of any business in that industry, with a profit margin, an EBIT margin, or an operating profit margin of around 30%, 28, 31, numbers of that sort. It's the return on capital, the return that Apple's earning for its investors that I'm interested in. And you'll see that Apple's asset turn is just like Dell's. They've got an infinite asset turn. How have they done it? Well, that's we can see that by looking at the detail of the balance sheet, which is the middle panel on this slide. And I've grouped the assets to suit the story, obviously. Let's look at the working capital first. What is working capital? Well, it's inventory plus receivables, the money your customers owe you, less payables, the money you owe to your suppliers. And it's clear that in all of these years, Apple's working capital is strongly negative. In other words, the balance sheet it needs to operate yields cash rather than requires cash. Inventory is almost zero. Receivables in the most recent year are 10% of sales. That means that each dollar of sales requires an investment of around 10 cents in the money owed by customers. But payables, the money Apple owes to its suppliers, far higher, 17 cents. So working capital is using minus 6 cents, 6%, 6 cents in the dollar of sales. Every dollar of sales yields cash. It leads to a cash inflow to Apple of 6 cents because liabilities grow faster than assets need to. And the other assets, the property, plant and equipment, various bits and pieces, the intangible assets that are in Apple's balance sheet, they are positive, but again, it's a small single-digit percentage of sales. Net the two off, and Apple's net assets are around zero, slightly under in most years. So again, in balance sheet terms, it requires no assets. And that's an extraordinarily powerful economic model. Right now, Apple's profit margins are very high, and Apple is, of course, growing very fast and is the apple of everybody's eye. It's not always been so for Apple. Apple has had some very turbulent times in recent years because Apple has always been willing to take big risks to innovate. Not all of Apple's innovations and product launches have been successful. So in some years, Apple's made losses. In other years, its profit margin has been very, very low. And the beauty of this lighter-than-air balance sheet, this asset-light balance sheet, which in the extreme, as in the case of Dell and Apple, requires no net assets at all, is that you can earn a return for investors, an infinite return in a sense, whatever your profit margin. And that's a very powerful strategic weapon in a risky, uncertain world such as the one that Apple lives in. Well, this is such an attractive model, this light balance sheet model, that of course everybody has tried it. Let me look at one or two other industries where famously people have pursued the same model but with different degrees of success. The hotel industry. At around the same time as Michael Dell was innovating his asset-light balance sheet, Marriott was doing something similar in the hotel industry. The hotel industry is one that traditionally had been quite unprofitable. It's a highly cyclical industry. In other words, the profitability, the return on capital of hotel groups is very much a function of the business cycle, as you always expect to see in an industry with high fixed costs and a lot of assets in the balance sheet. Small downturn in demand leads to a large fall in profits. So low returns, often single-digit returns, and very variable returns around the cycle that characterized this industry. An industry whose balance sheet was full of assets because the traditional hotel model was that the hotel company would both own the bricks and mortar and operate the hotels. In the 80s, Marriott pioneered a completely different model. They said this, faced with the grim economics of the hotel business. So what can we do about this? Well, we don't really need to own the bricks and mortar real estate. What we're going to do is sell those assets to somebody else. Maybe somebody who's better at managing than us. We don't particularly have competences in physical infrastructure. Or maybe we'll have a joint venture with a property company. So we'll set up a propco, a property company, shift the assets out of our balance sheet and into that balance sheet. And our focus will be on operating the assets, because we think that's where our skills lie and our competitive advantage lies. So the opco-propco model, as it's usually described, putting the real estate off the balance sheet. And this transformed Marriott's performance. It smoothed out the variations around the business cycle because they were able to write their operating contracts in a way that de-risked the profits to some extent. But of course, it made the balance sheet lighter. This heavy weight of real estate was no longer there. So both the variance but also the level of Marriott's returns through time improved markedly. But, and this is a characteristic of this, and this is the question that you may well have, that may be nagging at you as the audience, this stuff looks quite easy to do, and if it is, to the extent that it is, it's easy to copy. And that certainly happened in the hotel industry. Everybody else looked at Marriott and said, yes, that's a good idea, and we will do this. The OpCo-PropCo model was pretty much copied by everybody else. And in consequence, the advantage in running that model disappeared. So returns over the next decade fell back, maybe not quite to the level they had been, but to a relatively low level of profitability. So the cycle started again, and hotel companies started to look for new balance sheet innovations. And the next step, and this may be the final step in that industry, was to break the value chain into a third segment. Now, if you look at a company like, well, perhaps not Marriott, but some of the mid-range hotel groups, they're essentially operating in three parts. There's a property company, there's an operating company, or more strictly a brand management and bookings business in the middle, which is the recognizable Marriott business or Hilton business, whatever it would be. And the actual operation of the hotels is frequently outsourced to a franchisee. So that the hotel management at the sharp end will be done by a local management company. And so it goes on. There's constant search for new balance sheet models that simply use less asset and therefore yield better return in the face of a competitive market. Let's talk about Ford. Ford, again, faced similarly bleak economic, as the whole of the US auto industry or vehicle manufacturing industry did. Again, an industry that for decades had been unprofitable, earning profits but earning low return on capital, single digits very often, and very vulnerable to recession and economic cycle. Ford was, under the management of its then CEO, Jack Nasser, working closely with McKinsey, the consulting group. And they devised a strategy very similar in its way, tailored to this industry, to the one I've described in the hotel industry and to the one that the computer manufacturers followed. They simply looked at the value chain and said, well, what do we need to do and what can we get other people to do? And where are the assets in each case? And they decided that the bits they would keep would be the R&D, the design, the innovation piece, the creative end, where they had competitive advantage, unique skills in their view, and which of course required relatively little balance sheet asset, because there are assets needed for this: intellectual property, creativity, human capital, and so forth, but they're all assets that don't get onto balance sheets. Similarly, they thought they would keep the customer relationship, so the marketing, the customer end of the value chain, because they had some very strong brands and they were busily acquiring more. Now the assets there will be brand equity, customer relationships. These are assets that may or may not be on the balance sheet, but typically will not. So this is a balance sheet light segment. It's the bit in the middle, the manufacturing, the traditional metal bashing activity of the auto industry, as in any engineering industry, that was weighing down their balance sheet. And their ambition was to, as far as possible, outsource that and pass that on to third parties. And they believed at that time, I think hindsight shows this probably wasn't correct, but certainly their belief at the time was that there was no particular competitive advantage in manufacturing. The Japanese car manufacturers taught the world about just-in-time manufacture, and everybody could do it now, so why not simply outsource that to third-party constructors and manufacturers? It didn't work. And if you look at the profitability of Ford and the other big US car manufacturers in particular now, 20 years later, it's still pretty much single digits at best. Why? Well, I think for a different reason. Everybody was trying to do the same thing, for sure, but it wasn't imitation. And the inability of Ford to innovate and retain the intellectual property in those innovations that was the problem. It was simply the complexity of the task. So in this industry, in contrast to, say, the computer industry, which with hindsight is quite a simple manufacturing operation, the control, safety, and managerial scope problems meant that there was a real limit on one's ability to step away from manufacturing altogether. Yes, all of the big car manufacturers are now outsourcing probably substantially more of their construction than they were 20 or 30 years ago, but they've found a very real limit on their ability to do that. And in consequence, their balance sheets are still quite heavy and their return on capital quite low. Let me look at a similar piece of balance sheet innovation in a quite different industry. We looked at two manufacturing settings, and let's look at banking. One of the most striking, although currently quite small scale, changes in the banking landscape in the last few years has been the growth of peer-to-peer lending or crowdfunding. It's still partly, I think, because of its scale, its small scale, and its lack of familiarity, and the anxiety that people have about this sort of banking, whether they're worried that small investors may be irrationally lending into these crowdfunding platforms, the observation that there's regulation is currently very light, and the concern that maybe it should be heavier. All of that clouds the what's really, in my view, going on here, which is that this is a classic example of disruptive balance sheet innovation of the sort that I was talking about earlier. The incumbents, as we know painfully well since the financial crisis, large balance sheet heavy banks, often multinational banks. Banks who have attempted to be profitable in a highly competitive industry by shrinking the equity capital in their balance sheets as far as they can, and therefore have become quite risky and fragile structures that very easily fell over in 2008. Here's a completely different approach to balance sheet in this industry, because a peer-to-peer lender is typically a small group of individuals, maybe half a dozen, not much more, sitting in an office, running a highly sophisticated IT platform, or shall we say software platform for marketing their product. But at the core of that, a particularly sophisticated credit scoring algorithm. These are often very smart people, and they're building software for credit scoring that's as good as, frequently better than, the software run by the large banks and the large credit scoring agencies. And that way, they're going to the core of the banking business and providing the core service of banking, which is the analysis of credit, and linking borrowers, people who want to borrow, with people who want to lend, yet completely avoiding all of the legacy assets of a conventional bank. They have little or no conventional balance sheet, these people. They have no legacy of assets. And therefore they represent an extraordinary threat to incumbents. This is, I think, a piece of disruptive innovation that will transform the banking industry, and is certainly on a par with with what Michael Dell did in his industry all those years ago now. Well, let me stop at that point, and maybe this would be a good moment to take some questions.
So, Chris, with regards to the case of the example of Dell, Jeffrey Whittle wants to know, well, does this push the risk onto suppliers, and is this producing a longer chain than sales? Couple this with a question also from Mamadou. Might we also need to have more bargaining power over suppliers to carry out such a business model?
Yes, those are two excellent questions. There clearly is a risk shifting taking place here. When somebody's as successful and innovative as Michael Dell was, of course, everybody gathers around and tries to pick away at his innovation and strip it down to its bare bones. And one obvious criticism, well, one obvious observation is that yes, he's achieved this extraordinary financial performance. His balance sheet is now lighter than that, has no assets on it. But has he done that? Well, maybe by parking his assets, some of the assets at least, on other people's balance sheets. Yeah, I mean, to some extent, and we find it hard to judge the extent to which he's changed the world and made the world more efficient. I think he did do some of that. His innovations in manufacturing and logistics control were game-changing, but also to some extent, the assets he had before are now popping up on the balance sheets of the suppliers, the banks who are leasing him his buildings, and the customers, of course, who are sort of willing to pay in advance of manufacturers. We all have to do when we buy a Dell computer, and that's nice for him. But it's not. It may be the case that it's changing his risk profile, and that's the point of your question. And I think you make it a very valid point. A balance sheet, a conventional balance sheet, a heavier than air balance sheet, the balance sheet of a traditional vertically integrated business, gives you control. The price and what you may lose by shifting assets off the balance sheet to some extent is control. And the question for the Dells of the world is whether his sophisticated logistical system, his IT control systems, enable him to de-risk his business, because now he's using assets that are on the balance sheets of other people, and therefore he's exposed to the risk of their balance sheets.
With regards to the peer-to-peer lending example, what do you think of the case of in the payment money transfers outside the banking industry practice, similar to what TransferWise does with currency exchange? There's no balance sheet needed. What do you think of that in terms of a disruptive balance sheet?
And again, an excellent point. I think if we were looking at the banking industry, the other example we could have used, which would be equally valid, might even be more powerful in terms of the impact it's currently having on traditional bank balance sheets, is the innovation in terms of money exchange and credit exchange, and the success that non-traditional payment systems are having in upstaging, replacing, disrupting the traditional payment systems of the conventional banks, with the balance sheet underpinning of the conventional banks. Now that is also a very good example, I think, of the same phenomenon. It reinforces the point that everywhere we look now, we see disruptive innovators with models that require no balance sheet or require radically less balance sheet, and therefore will thrive in a world where profit margin is under intense pressure. Because, to repeat, and let me take this moment to reinforce the main point, what we care about is the return on capital of the business. We know that businesses need to earn a decent return for their investors on the capital they're using. And that boils down to two simple drivers: the profit margin on sales and the balance sheet intensity relative to sales. Given the challenge of profit margin these days, balance sheet is the disruptive place to work.
Well, this goes somewhat in the same in the same vein. This is coming from Joe Butzler, and he says, or asks, for a manager of a company that is not listed, if the investors don't ask for ROCE but for sales and profit margin, any motivation to focus on reducing the size of assets on the balance sheet?
Absolutely. That's a question I often get asked. It sounds like the language is all about the listed company and the vocabulary of return on capital and value creation. Not really. It's the language of economic performance, and it applies equally to unlisted as to listed companies. Somebody is providing the equity capital for an unlisted company. It may not be public shareholders. It may not be shareholders on public markets. It's the principle of the business, and that principle is going to have to be just as concerned about the profitability of the business and just as alert to opportunities for shrinking the balance sheet if that business is going to survive. Because as we know, to the extent that unlisted companies tend to be smaller companies, they are companies that are particularly suffering in this very competitive world we live in. They really need to be on the lookout for balance sheet innovation.
If we have time to ask 3 more questions. This came in from Sid Narang. It's with regards to the hotel industry example you've used. What do you think of the innovation in hospitality industry that is P2P, sharing economy of leveraging second homes to displace the hotel industry? What are your thoughts on?
Yeah, again, excellent. And I think I'm glad to see that people listening to this webinar are getting the point. The more we think about it, the world is full of these examples. And in the hotel industry, yes, that's very much a peer-to-peer hotel industry. It nicely marries 2 of our examples here. I suspect that the scope for that in terms of market share might be limited, because there will always be a demand for the large full service hotel. But in the same way, you might argue that the scope for peer-to-peer banking may have its natural limit. We haven't got there yet. Both of those segments, peer-to-peer banking, peer-to-peer lodging, are growing very rapidly at the moment, and it's quite exciting to see that and to speculate on where they will end up.
This is a 2-part question from John Galani. Where do you see margins on manufacturing if you disintermediate the innovation process from it and offload their balance sheet assets? And then I'll follow on with the question after that.
Yeah, that's a complex question. So let me sort of answer different parts of it. In the cold competitive world, and this is really what we saw in the hotel industry, this really is the best example of this. All of these innovations, including my theme for today, which is balance sheet model, balance sheet innovation, have a half-life, because to the extent that other people can and will copy them, they cease to offer an advantage to the innovator, and margins will again be under pressure, and the overall return on capital model will again be under pressure.
Perhaps that's would go on with his follow-on question is, would you not say that the Chinese manufacturers have acquired enough transfer knowledge to use their balance sheet, not their profit margins, to leapfrog back the innovator? And that goes on with what you're saying.
Yeah, and that's going to be interesting to see. I don't know the answer to that yet, and we don't really know enough about how China will play out in those terms. But again, applying the same framework of ideas, if Chinese, there is this prejudice, I know, this belief that Chinese companies will enjoy the technological innovations of Western companies, if they can do that and at the same time copy these lighter than air balance sheet models, given their cost advantage, then they will turn out to be relatively high margin businesses and therefore relatively high return businesses. I think what we've tended to see so far is that they have low costs, maybe charge lower prices, so the margins may or may not be higher, but the typical Asian balance sheet has been quite a heavy one. There's no reason to believe that will continue. So how the profitability equation evolves internationally is going to be intriguing to see.
And this final quick question is from Joel Pham. if we assume that the balance sheets evolve towards lighter than air balance sheets, then how will the relevance of ROCE be as most companies will reach infinity in terms of ROCE?
Yes, a good point. Well, in a technical sense, ROCE will still be meaningful. I mean, they have an infinite ROCE because they're using no capital. But it ceases to be a very useful measure for performance measurement and for comparing companies. And at that point, what I always counsel people to do is shift to a measure like economic profit, which takes the same data but presents it in a more meaningful way. So if you recall, the economic profit of a company is its profit less a charge for using its capital employed, rather than the ratio of profit to capital employed. It's the same data, but it becomes meaningful again, because now if a company has no balance sheet, a lighter than air balance sheet, there is no capital charge, and its profit after tax is its cash flow and is the increment period by period to investors' wealth. So that becomes the number to use when we're doing economic storytelling using financial statements, which is what we're always seeking to do.
Okay, thank you very much for your time today, Chris, and thanks for your excellent insight as always. Thank you to everyone online who's downloaded this webinar. The details, we're just going to get up on screen now, the upcoming accounting and financial analysis programs on which Professor Higson teaches on, just on screen there now. I mean, do contact me if you'd like any further information about these programs. I have detailed course syllabus I can email you, and any other details you need. The contact email is quite easy to remember. It's just finance@london.edu. And so if you'd like to know anything about Chris Higson's upcoming programs or any of our other finance portfolios, do get in touch. From myself, Anne White and Chris Higson, goodbye. We hope to see some of you in the new year at London Business School, and thank you for downloading this webinar.